Oh my gosh. This is the best present ever. Great aunt. Thank you. Thank you. Thank you so much for giving me a Chanel bag. Okay, what type of Chanel bag I got? I can't wait. Oh my gosh. It's one of the original small handbags from Chanel. Wonder what year it is. Ooh, this is like vintage. From 1955. Oh, it's one of the very first Chanel bags. Oh my gosh, it's worth a ton of money. I gotta check how much this is worth. Huh. Oh my gosh, it is worth $10,500. I have a $10,500 bag right here. What if I sold it and get all that money? What can I do? Go to Paris on a party with all my friends? Oh yeah, let's go to a party. I'm gonna sell this handbag for a party in Paris with my friends. Ooh, I'm gonna do that now. My friends are gonna all love me. Hello everyone. In today's video, I want to talk about everything about capital gains in Canada. Now, capital gains seems to be such a complicated topic. I mean, for me, just learning about it over the years, I realized I was always confused over like how it's taxed, how do you even calculate capital gains, how do you offset capital gains. It took a lot of research to build this video. I want to digest everything in as little as minutes just for you. So in today's video, I want to cover what are capital gains, what's a simple way to calculate capital gains taxes, a super simple way. I also want to talk about the difference between realized gains, unrealized capital gains, and most importantly, I want to talk about these three very unique ways to reduce or completely not pay any capital gain. And these three very important and very unique ways are something that it took me a while to actually figure out. And this is not just about stuffing your money into registered accounts to offset and not pay any capital gains, like the usual, like, hey, put your money into TFSA or put it into an RSP or RESP so that you don't have to pay any capital gains. It is not about that. So you definitely want to stay until the end of the video because I share three very unique ways to offset capital gains. So if you are a small business owner or a professional or basically someone who has sold some stocks and have some capital gains, or you own rental properties because you're a real estate investor, well, I've got something for everyone. You definitely want to watch today's video. Hello everyone, it's Tracy here. I'm a former engineer, now business owner, and I host the channel Financial Nirvana Mama, where I talk about passive income, building multiple streams of income using stocks and real estate in Canada. So if this is something you want to do in Canada, then you definitely want to hit the subscribe button and that bell notification button so you get the latest and greatest videos coming to you every single week. So let's get back to the video. So over the last 3 years, I sold 3 rental properties plus some stocks. And well, it's nice to have some profits, you know, it's like tangible money in your hands. Well, technically in my bank account, but you know, and it's so tempting to like, spend it all on a big party. Like when you're selling your Chanel bag and then you want to blow all that money on the party, it's so tempting. But unfortunately, in Canada, when you make a big profit or any profit, especially capital gains profit, the tax man is after you, which is CRA. But first, let's define capital gains. And I'm going to spell it out super easy peasy for you to remember. Capital gains is the profit you make after you sell something that's more than what you paid for. So for example, if I get the Chanel bag, obviously not real Chanel bag, but if I get a Chanel bag and I sold it, okay, I sold it after holding on for a few years. If I bought this at like, I don't know, like $1,000 and it goes up to $10,500, then I pay taxes on that capital gain. So my cost would be $1,000 and this purse is worth $10,500, which means that I net a profit of $9,500, which is my capital gains. So the average cost basis, which is the purse, the cost of the purse minus the sold price, is the capital gains. But let's change the example just to be a bit more complicated because this is probably more realistic. If you took this same Chanel bag, you're probably likely not going to sell it on Kijiji straight ahead. You're going to get a store to help you like sell it in a vintage store. So say the store takes 10% of the profits And this purse, remember, cost you $1,000, and now you're trying to sell it for $10,500, and it does sell $10,500. But again, you've got the store to actually take commission to sell it for you and to confirm its vintage and everything. Then say they took 10% commission, that means 10%, $10,500 is $1,050. So the net profit you make is the purse sold price, which is $10,500, minus what it costed you to buy this purse, which is $1,000, plus the commission that store made, which is $1,050. So that means your net profit is $84.50, which is your capital gains. Now let's talk about how much taxes would you pay on the Chanel purse. Remember, your capital gains that you made on the Chanel purse is $84.50.
Now in Canada, we are so lucky that only 50% of the value of the capital gains is taxable. So in our example with the Chanel bag, remember we made a profit of $84.50. So you only take 50% of that, $42.25, and then add it to your income. So the amount of tax you'll pay depends on how much you're earning from other sources. Now, even if you had income and you were still in the lowest income tax bracket, even with the Chanel bag profit, and it adds up to $49,000, then you're still in the lowest income tax bracket. Now, if you jumped over to the highest tax bracket and you made over $235,000, and then you added the profit from the Chanel bag, well, that still puts you at the highest income tax bracket. So you take half of $84.50, which is $42.25, and add it to your $235,000 salary, and then you still pay at the highest tax bracket. So really, the amount of taxes you pay depends on how much you make plus all your other income sources. Now, if you want to roughly budget how much income taxes you'd pay, I always do the simplest method, which is I take, say, if I made $84.50 on my Chanel bag, and say I'm at the lowest income tax bracket, then I just take 10% of that. That's what I'm going to have to budget for taxes.
Oops, I forgot. I have one more thing I want to touch on, which is unrealized capital gains versus realized capital gains, before we talk about the 3 very unique ways to offset capital gains for everyone in Canada. Okay, let's touch on that. So using the example of the Chanel bag, say you held onto this bag, decide not to sell it, and blow it into Paris, with a party, which would be pretty cool, but, you need some money to pay for taxes. And you're like, you know what? I'm going to hold on to it because it keeps going up in price. So the Chanel bag goes up to $20,000, but you never sell it. Say in like 10 years time, you pass it on to your kids. Well, that is unrealized capital gains because you never sold it. That means you made money off of this purse, but because you're still keeping this purse, it's unrealized. Now, the moment you decide all of a sudden you bring it to a store and the store decides to sell it for you and it's sold, then that is realized capital gains. And that's when the moment you sell it is when you actually get taxed on it in that year. Now, also, if you decide to sell stocks in your RSP, RESP, TFSA, obviously, as long as those stocks are in those accounts, you don't pay any capital gains, okay? Now let's talk about the 3 very unique ways that you can use to pay $0 in taxes or reduce your capital gains taxes to almost 0. And we're not talking about stuffing into RESP, RSP, or tax advantage accounts. This is very unique, and this is got something for everyone. Look into the principal residence exemption. So hear me out. This is super important because it has a little bit, it's very unique. Let's just talk. It's very unique, and I'm about to explain it. So this principal exemption is where, hey, if you own a primary home and you sell it in Canada, we're so lucky. We don't pay any capital gains on it. But say you own a home in a very small town. I don't know, maybe outside Ottawa, because I live in Ottawa. I'm going to use Ottawa as an example. So you bought this home in a very small town, like outside Ottawa, maybe I don't even know all the small towns outside Ottawa, but super far away. So it hasn't done so well because it's in a small town. Capital appreciation, the home price hasn't gone up a lot over the last decade, for example. But you also own a vacation home, say near Ottawa, okay? Maybe you own a vacation home near Ottawa and you realize that your vacation home has actually done really well in terms of the price, okay? Meaning the real estate prices for your vacation home is gone up so well compared to what your primary residence has done. Well, you could possibly change your vacation home and become your primary residence and use the principal residence exemption for that vacation home. Now, of course, I'm not an accountant. I'm just saying that this is a strategy that I've led. So please check your account is this something you can use? Because if you can use this, you could pay 0 capital gains on your vacation home when you sell it. And because the home that you actually live in isn't making so much money because it hasn't gone up in price, then you're not going to pay capital gains anyway. So I would say maybe you could consider switching the principal residence exemption to your vacation home. Number 2 is defer capital gains. So how this works is that you are able to transfer shares only upon death or divorce tax-free once. Okay, so that means if you, for example, you go through a divorce and your partner has a lot of Apple shares, okay? Instead of having to sell those Apple shares and split the money with you, well, your partner, well, obviously ex-husband now, could actually transfer those shares 50-50 to you tax-free, okay? This is a one-time thing. You can do this tax-free. Or if you die, of course, all of us will die one day, and then you have a bunch of stocks like Apple shares, and you decide you want to transfer to your kids, you can also transfer it once tax-free. Now, you can't combine both methods. So for example, in the example where I said, hey, you got divorced and you got the Apple shares, and then now you're wanting to transfer the Apple shares to your kids, you can't do that tax-free. You could defer it once only. So I would say write a will, talk to your lawyer. How do you strategize this? But you can transfer the assets, being stocks, to your kids or to your spouse tax-free once. Now, this unfortunately doesn't apply to rental properties. So if you're thinking you want to do this with the rental properties, you can do that. The third one is called the capital gains reserve. So all this means is that instead of like selling something and then giving it to your kids, like say a rental property, you could actually spread it over and get your kids to buy it from you over a 10-year period. Let's use as an example that a lot more people can relate to. Say maybe you had a really nice grandpa, okay? And your grandpa decides to sell this beautiful vacation home to you and decides to do this before he passes away. And instead of you having to like pay a huge amount of capital gains, he's like, hey, I'm going to sell it to you at a really good price. And I'm going to sell it to you and you could pay it back over a 5-year period. Wouldn't that be amazing if you could buy a vacation home at a really good price over a 5-year period? This is what your beautiful grandpa is going to do for you. And how your grandpa is going to win is that he's going to collect the money over a 5-year period. Remember that our tax rate is based on how much we make that year. So if you decide to spread the profits over a 5-year period, that means you can go in lower tax brackets over the 5-year period versus just getting a big lump sum of money in 1 year. So your grandpa's totally winning. So he could offset the profits over a 5-year period, put it into lower tax brackets because he's on a fixed income, and pay way less taxes than getting you to pay him, big lump sum of money. Probably can't afford that big lump sum of money in 1 year. So your grandpa's doing you a favor. Now I'm going to give you 2 more bonuses because, I love sharing. So the first one is you can donate your stocks to a charity. When you do that, you can offset capital gains because you sold it to a charity, and it could be decided on what price it's sold at, but basically you pay very little taxes if you donate your shares to charity. Another way is obviously the tax loss harvesting method. Now I have a whole video about that up here. So if you want to get into the nitty-gritty detail about tax loss harvesting, you want to do that here. So essentially you sell some assets, say some crypto that maybe you didn't make a lot of money on. In fact, you actually lost a lot of money on. But then you also say sold your Chanel bag because it made, $8,450. And you lost $8,450 in your crypto account. Well, there you go. It's all in wash. You don't have to pay any taxes because you sold your crypto assets, magically appeared to be $8,450 in losses. And then you also made money on your Chanel purse, and then all that came in the wash. And in the end, that year, you paid $0 in capital gains. Now, if you have more questions about capital gains, like maybe what year it applies, what accounts, all that, ask me below. I'll try my best to answer it. And if you want more videos on passive income in Canada, check out this playlist up here, because who doesn't like making money when they're sleeping? Plus, you pay less taxes using the capital gains tax rate.